Hey there, Investorholics and friends. Welcome to another ETF Spotlight review. Today we're taking a bit further, a deeper dive into NDQ, which is the BetaShares NASDAQ-100 ETF. It's a top little ETF. Hang around and we'll give you the lowdown and all the glitter and gold. Well, hello there, Investorholics. This is Scott. KrackTheSky Value Investing will be giving you up-to-date investing news and content so you can navigate the markets wherever you are. My mission is to give you the knowledge and confidence to take control of your own personal finances, expand your investment horizons, and crack your financial sky. Righto, now let's just dive straight into the spotlight. So investment objective, NDQ tracks performance of the NASDAQ-100 Index. The index provides investors with exposure to the performance of the 100 largest non-financial securities listed in the NASDAQ stock market by market cap. Why are we bothering? Investors can access many of the world's most innovative companies that continue to revolutionize our everyday lives, such as Apple, Facebook, Amazon and Google. A core portfolio holding of US growth equities provides transparency and diversification benefits. I suppose, you get a bit of a tactical exposure to global technology assets. It's lacking a little bit in Australia. Complement and alternative to investments with active managers focusing on the US equity markets. So our last trade was $22.94. The day before that, net asset value was $22.69. Market capitalization of $753 million. Pretty reasonable management costs. 0.48%, not too bad. You'll have a distribution semi-annually in January and July. Dividend yield of about 2.18%, which isn't too bad for a tech stock anyway. Focused in the States, it's usually quite low, around 1.5%. NASDAQ allows investors instant exposure to some of the largest, most innovative companies in the global technology sector. By owning NDQ, you will gain exposure to US equities and US currency. There's a bit of currency involved in this one. Most Australian investors should be interested in this ETF due to the limited technology options in the ASX, or on the ASX I should say. There's not a lot of great companies currently listed. Over the long term, so I'd call the long term more than 5 years, the underlying companies' prospects look very strong, and the ETF should continue to perform well. In these crazy times, I think these techie type companies are actually going to perform better than some of the other companies. I think it gives you exposure to some of the biggest movers and shakers in the global technology. The current top holdings, as we kind of touched on a little bit before in the previous slide, are Apple, Facebook, Amazon, Alphabet, Intel, Cisco, Netflix, Tesla, and Starbucks sneaks in there as well for a cameo appearance. I think they're some of the best companies and some of the best brands in the world. I think it's not a bad little option if you're looking for some diversification. Also have a bit of a look at IVV and ZYUS as alternatives while we're doing our research. So taking a look at the fund returns after fees, pretty healthy. Since inception, we're looking at 18.31%. So the ETF was started on the 26th of May 2015. So you've got a little bit of history behind you there. So 3-year performance, 21.89%, not too bad. So as we touched on before, you're looking at Microsoft, Apple, Amazon, Facebook, Alphabet, Intel, PepsiCo, Netflix, and Cisco Systems. So all very large companies. The ETF has delivered great performance for ASX investors in recent times, despite our little stock market turmoil that we're facing now as we speak in 2020. Performance does include some currency fluctuations. So like as I mentioned before, because this is a American ETF, there's going to be a little bit of currency wiggle and higgle and piggle here and there, but that's not too much of a concern. It's actually helped to boost the returns anyway because the Australian dollar's gone down. I believe that the companies are amongst the highest quality businesses in the world and capable of driving the NASDAQ index notably higher over the next decade. So as I sort of touched on before, it's something that I would actually have a harder look at. These tech companies I think are actually going to gain a larger market share than what we've already seen. So definitely something to consider having in your portfolio for the next 5 to 10 years. I think you get some pretty good gains out of it anyway. Are you interested in learning more about personal finance and investing in the markets? If you are, then smash the like here on the left hand side and caress the subscribe button on the right hand side. It's KrackTheSky Value Investing. We'll be giving you up-to-date investing news and content so you can navigate the markets wherever you are. Expand your investment horizon and crack your financial sky. Thanks guys. See you later.